Welcome, ladies and gentlemen. This is the time for the next session of the day. The future of investing, behavioral finance, and AI. Please, as we all have seen her come on stage, welcome, ladies and gentlemen, Miss Yulia Myronova, CEO and co-founder, Yainvest. Give her a big round of applause, ladies and gentlemen. Stage is all yours.
Thank you. Can I have the device? Okay, before the device is here, I'm first of all very grateful for you to be here. I hope to be as useful. So you can sleep on the session and have a little nap. Okay, I'll say change the slide. There's a lot of slides, unfortunately not a demo. So please, let's make it as interactive as possible. Ask as many questions as you can. Interrupt me anytime, because I brought you some heavy content. But in order for you not to fall asleep, how many of you are investing here? How many? So almost half of the audience. And how many of you are professional investors? Who is its daily job? Oh, just one hand. Oh, two hands. 3, 4. Okay, I'll try to adapt it as for non-professional investors. But from those who invest, how many of you are happy with your performance? 1, 2, very few hands. Well, that has an explanation. And explanation lies in behavioral finance area. And that will be a first part of our session. A couple words about myself. As most of you, I'm Ukrainian, so I come from emerging market. I worked in all post-Soviet countries. And last 10 years it happened, and I worked in technology and entrepreneurship. And it happened to me, I'm an engineer myself, mathematically savvy. It happened to me as a life coincidence. 10 years ago, I found myself in wealth management in Switzerland. And it was brand new, it was like a shock for me, I would say, cultural shock from many perspectives. But the major perspective was a practice in Switzerland to hold money that does not exist, that something that made people wealthy and something that made, let's say, people in my country poor. So the practice that made people wealthy in Switzerland does not exist in Ukraine and Russia, and oftentimes, our post-Soviet countries, let's say, oftentimes even ignored or neglected. It's a cultural, educational things, but also in Switzerland, there is a very strong impact of academia and the latest research in the industry. It's all about safety, security, and it's all about applying the latest research into practice. So this is exactly what Yainvest is doing. We are the company that commercialize the research in Swiss universities from professors who contributed heavily to the development of behavioral finance. And we build it as a software and make available globally. Eventually, we also have a presence in India and work with Indian companies that are very advanced and open to this. I would say even more advanced than the US, which is the most advanced market today. Speaking about behavioral finance, if any of you would take a CFA cert level, and probably if you have financial advisor, you would want him to have CFA cert level, like a doctor. CFA cert level is all about behavioral biases. It's all about behavioral finance. Why is it so? Because it's known already that we are humans. We were not created for investment decision making. Investments is a risk. And it's not about get as maximum possible outcome from your investments. It's about understanding both risk and return, understanding many things at the same time, which our brain was not created for. So as soon as we make, so history of biases, thank you. You turn the slide. As finance is conservative area, so it takes decades to adapt new concepts into the practice. Like if you ever heard about like portfolio, like Markowitz theory for portfolio diversification, so how many assets you need to have in the portfolio, it's been 30 years before it became a practice. Now, behavioral finance, in our view, is making same impact as Sharpe ratio, Markowitz theory, and many others that are true today, but proven to be not efficient. So behavioral finance incorporates the deviation that we are human making during the investment decisions. It learns what are those deviations, how do they work, and offers the remedy. And it started in 1979 by prospect theory, Kahneman and Tversky. So if you ever read book Think Fast and Slow, this is explains on this. It's like a motherhood of behavioral finance. And then the biases, which is area of our business, is recently new. It was discovered around 20 years ago. And since then, many researchers around the world, including the Indian universities, are focused on studying these biases, studying our decision making, and there is a lot of papers produced, including my co-founders, that since 2006 practice to adapt this research to real-world cases in wealth management and investing in Switzerland. Today, and for the last 5 years, we run the research how we can combine this knowledge with machine learning, and I'll show you what we did. If we go to the next slide, and now I'll start a little bit fast. Please interrupt me anytime. If you said, I don't understand something, or it's too complex, it's just fine to say stop and explain again. Or challenge along the way. So it said, why is a problem? Because it really hurt your investments. You all said, I'm not happy with my investments. Yes, because non-professional investors, like sorry guys, no chance, including for myself, that we will make investment decisions without the biases. And the difference in between what is the optimal investment decision and investment decisions that are being made is called behavioral gap. Behavior gap, as a term heavily promoted by Morningstar, they publish the reports about behavior gap every year. And what they said, even in developed markets, like retail investors invest in the US for like dozen of years, the average gap is 6% per year. So every time you yourself invest, expect to have at least 6% of lost return per year. And this is normal. When investment professionals invest, and there was a recent study from MIT and CFA Institute, they lose at 92% of cases, at least 1.2% of return per year. So even professional investors, whatever they do with procedural measures, all the data, all the supporting AI, they still making this gap. And if you think about billion managed portfolio and your pensions portfolio, your savings portfolio, your country wealth portfolio, you lose billions just because we are human and not being created for that. In advisory case, it's 2%, as Vanguard said. If you go to the next slide, and so the problem is real, problem is big, problem is known. CFA, all the modern financial education would be focused on that problem. Problem happened about just a reiteration. So the blue line is you make actual decisions and buy, sell decision, buy, sell, hold decisions, and then you're affected by different biases during the judgment because you got the information and then you make a judgment and then you make a decision. And if you say, oh, we can replace our judgment with AI, the bad news that many AI algorithms inherit human judgment and human biases because they're built by human. So until we understand our biases, well, we will not be able to build the algorithms that are bias-free. And the gap is huge, as I said. If we go to the next slide. Behavioral finance is adapted already in the US and in Switzerland, well adapted. There are some tools and algorithms exist. For example, investor behavioral profiles that are used at scale in the US, more than 50% of the market penetration, because in average, advisors serve more clients and they need more tool to understand the psychological trails of these clients. these behavioral profiles, it's like ex ante. They can estimate. They are estimating what might be the impact of the biases, but it's not precise enough. Also, it's adapted. And behavioral finance, if you go to the next slide. So from previous slide, you've seen it increases the relationships with individual, but in latest wealth management reports or investment reports, it's a demand of new generation from all over the world because many people study finance today, and 1/5 of financial courses anywhere in at least in developed worlds and dedicated to behavioral finance. And then you go out as early young individual who inherit or build your wealth or first investments. You go to your bank or advisor and do you apply this? And you see that they don't apply this. It's equal not having, I don't know, e-banking. So in a couple of years, banks or advisors, they don't incorporate behavioral finance practices might be perceived as dinosaurs that do not incorporate e-banking or digital channels. Did any one of you recently did financial education? Okay, then it might be like a CFA 0 course in financial education. If we go to the next slide, the use case of what we do, and I'll show you what exactly our company is doing. We built our technology as API first and very neutral to different use cases, markets, asset classes, and regulatory regimes. And it has many use cases. For example, if you make your own decision, the technology can augment your decision and help you to at least to be mindful about what it is wrong. In financial services terminology, it's called self-directed investors. So investors that make their own decision, a self-directed investor. In wealth management, which is the core of our business, is because we're in Switzerland and this is where we come from, our expertise come from. By using our technology, we'll help to validate external fund portfolio managers to make sure that you allocate your money to the portfolio managers that adhere to the highest standard, that really got the returns they got not because of the luck, not because of some other factors, but because of the skill. And to managers who help individuals to make their decisions, they can understand, okay, better from data, what is their behavioral trails, how I can help them, and give more personalized advice. You can compare portfolios, again, investment strategy in a neutral way across the markets, across different advisors and regimes, and clearly, like behavioral gap, it's measures that doesn't depend on the strategy or the market. And yeah, obviously, we have a lot of demand. Yeah, thank you. A little bit again about our company. As I said, my co-founders and Enrico and Torsten are professors at University of Zurich and University of St. Gallen. We practice this from 2007. And there are many banks in Switzerland and beyond that already built on their know-how. In the past, they provided mathematical models, and bank built software themselves. This is how I met them at UBS. I built software based on their mathematical models, and then we created this company to deliver software, ready solutions that incorporate all this know-how. Before I move to solution, next slide is our team. And we made sure that we brought the best industry practice with academia. Like our head of quant was 10 years at JP Morgan Asset Management in London. CTO built the entire Bloomberg ETF infrastructure in New York. So he's based in New York, and yeah, I've been to our customer and sales team. We were at global banks. So what I'm saying to you is the latest research adapted to the latest industry, like top-notch needs and implementation. So it's real innovation. And are we ready for solution? Any questions so far about, yes?
Self-space investment that you were talking about,
Excuse me?
The self-investor, like a person who invests for himself.
Yes.
The focus area, one of the focus areas that we have.
Yes.
Is it also educational that your product is, that why the decision is taken, or is just focused on the suggestion that this is the suggestion?
I'll present it now. I'll present it, but before that I can say we are a B2B company, because going B2C I would need to incorporate lots of context in every market and focused on UI. And plus I need to invest into markets and customer relationships, and it's very expensive and it's not global. So we are very focused on algorithms and solutions, and then we work with our big customers across different markets to that they adapt it to their specific workflows, to their specific use cases. And for me personally, I'd like to make this solution available for retail investors globally. For the reason, it's my personal reason, because at the beginning I said I come from emerging markets where wealth accumulation practice does not exist, and it's very simple. So I believe that if the proper wealth management practices used on scale by retail for 2 decades, anyone could be Switzerland. That's my personal mission and belief, to be honest. Yeah, so this is a little bit of theory, how it works, and theory on performance appraisal and management. Ex post is looking into the past, ex ante is anticipating the future. And today we already can look into the past and say what was the biases, what was the cognitive errors the investor made in the past, and how much did it cost. And I'll show you examples how we do this. It will be a little bit complex, but stay with me. But everyone says, I know my past, so what? I really need to know the future. And to adapt any machine learning algorithm, like this is my future, it's like, it's no-brainer, but does it really help you? Like regression model, I can predict from the past. Does it really help you? Is it really accurate? Did it incorporate your context? Is it based on the solid scientific foundation? Is it explainable that we can trace back the decisions? So all of this very complex question, and before to provide a behavioral intervention, a suggestion, have to mitigate this gap. A lot of research, like 5 years research, was put into place, and we're still building this solution. It's our foundational models. It's called theory-guided machine learning. We tweak and adapt every type of machine learning model we use for different workflows in prediction, in diagnosis, in more deeper understanding with the theory. In behavioral finance, we like marry together the old school theory with machine learning. Traditionally, machine learning would produce some numbers, some results, but it's a huge effort to explain these results and understand what does it mean, is it result robust or not. So we do step back, and all the parameters in the models produce the results that we might expect. It's a short description. Theory-guided machine learning doesn't really use in finance at the moment. It's used in physics and chemistry more often. So this is our invention. And in terms of how it looks in the product, if we go to the next slide, it's exposed available. We take historical transactional data and measure 6 most common biases and how much did it cost in different periods. So that manager can say, oh, because I had a wedding, or because I don't know, I was in a bad mood, or because I used a new tool, or because I did some adjustments, I got the gap. And indeed, we see very different patterns in different data sets. And we can clearly trace, for example, for fund managers, institutional, there's a portfolio manager of fund. When the change of portfolio manager happened, we also see the trace of the same portfolio manager across different strategies. So it's like every portfolio is unique and tells a story. And probably you might ask about what are the most common biases that people have. It's first of all overconfidence. Like we tend to be overconfident, and especially professional investors are very overconfident. It made them successful, but oftentimes it plays a very bad job for them, for their performance. Under disposition effect, so few biases you might remember. It's buy losers, sell winners. It's about market timing. Again, you never know what the timing is right, but a very good professional investor, they know. Warren Buffett makes money on disposition effect, and it's been proven by many research papers. The other bias is risk tolerance overestimation. That's the most common, especially for retail investor. As soon as your investments go volatile, there's a certain deviation, then it's very difficult to stay invested. Did it happen to any one of you? Yeah, that's, of course, yeah. That's what happens. But with these tools, and especially once they become available at your brokerage platforms, you can see when it happened and how much did you lost. Yeah, and what to do to avoid these mistakes in the future. Well, that was amazing, right? But that's not enough, and you want a system that would augment your decision making. This is AI system, so everything when we speak about anticipation of future, it's AI. And this is exactly what we built. So based on your past actions, based on your holdings, based on the market movements, based on the fundamental data, the system we built would preemptively inform that this problem might appear again with your portfolio and what you're supposed to do. And if you make an action, how much would it cost to you? Because maybe you would say, oh, I know better, or I don't trust the system, but the system would estimate the impact. And from the past, you would also see how much would you make if you take this suggestion that the system also builds a trust, and over time you say, oh, I better use the advice of this AI system and improve my portfolio. What we built is to be embedded, so it's something that you might expect to see in the years in your brokerage and portfolio management solutions, and this is the future of investments. The systems that augment the decision making, considering the fact that you're human, not a robot. Use cases. Now we go into a very difficult part. I've already lost some of the audience. Now it's getting even more complicated. This is a pension fund case. It's a little bit institutional, so you can have a look how your pensions are being managed. It's a $1 billion pension fund and a new manager. And the new manager get into the job and they start to trade, they start to do some actions with portfolio, and then they show next quarter, guys, look, comparing to previous quarter, I made 14%. I'm a very good manager. But the result, if you start to measure this systematically, was temporary, and the gap has started to increase. If we use a behavioral risk management, we would already seen that that was a biased decisions, and the biased decisions doesn't lead to positive outcome on the long term. And in fact, he could make it much better. He could make 8%. So this is the beauty of it, because in this simple case, of just half a year, he said, "Oh, I made 8% in 2 quarters." But he could make 26, and he doesn't know how, and he doesn't seen it. So this is how the system is built to augment at least awareness that there was something wrong. If we go to the next slide, I picked this fund. We work with Morningstar a lot to analyze the actively managed funds. Arc Innovation, Katie Woods. I picked this fund randomly because I invest into technology myself. I'm a woman myself, so very famous woman who invests into technology. Let me pick her fund. Otherwise, I would go and invest straight away. But I open up Morningstar and I see that in 2024, the return of this fund was 8%, but they promised 15, and the peers average was 15%. And even the benchmark in this category made 23%. So they underperform heavily. There is something wrong in their process, people. And Morningstar says, so today, with risk measures as of today, this style doesn't explain the gap. So there's something going on. They don't exactly know why. Why they made underperformance. So if we go to the next slide, it was very interesting for us. We call it lucky case, and we bring it into different conferences and sales papers. It's not going to be this way all the time. But picking the random days in 24, beginning 25, our models has identified that their underperformance towards benchmark was exactly due to behavioral gap. So it was exactly because they misbehaved in a classical way. And why? On this graph, you can see that there is a zero. Professional investors sometimes make money on biases, but oftentimes they also lose. So what the problem they had is overreaction to volatility. If we go to the next slide, overreaction to volatility in the context of professional investor is a risk measurement. In the context of retail investor, you just see your stock went down and you start to panic. It's you react to volatility of the stock, which might be for many reasons. It doesn't mean that something is wrong with the stock. In context of professional investor, they set value at risk or different risk management parameters when they exit the position. And what happened to this fund, they changed the risk management function and that parameters in 2024. So it doesn't mean that this is a bad fund. They changed something, and through this change, perhaps we're all human, they made some mistakes. That led, especially in quarter 3/24, when the previous risk manager left the company, to underperformance. Our models has detected that. So our models first measure, okay, do they behave this way or not across different biases? Oh, we captured, and then we separately measure how much did they lost, because behave and impact of this behavior can be positive, can be negative. It depends on many factors. And it's oftentimes 92% it's negative, but in 8% it could be positive. They can make money on these actions, on trading, on volatility. And we've seen in professional investors, they know how to trade on volatility and make money on that. So this fund, if I use our system to analyze whether I would invest into this fund or not, I see that when the Trump volatility happened in quarter 2/25, they were very disciplined. And to be honest, 2025, they performed very well because they made adjustments, and we update this use case to show how well they performed and how our models captured their good behavior. If we go to the next slide, example of another bias, disposition effect, it's market timing. In this area, they sold winning positions that recovered. They sold winners and keep losers, so they keep lots of positions that underperformed. The way we measure them, so index captured that. Again, a result of risk adjustments. And professional investors normally would make money in a relative way on this bias, but the level was so high that return has deteriorated. So again, this is the way I look into my investments when I invest into the fund. If we get back to the previous slide. Yeah. When we invest into the fund, if we get back to the previous slide. Yeah. Yes, so I see that the index goes up, return deterioration happens with delay. That would indicate that performance of this fund would deteriorate, and maybe I should do something. As well as if I track myself as individual investor, I did certain actions, and I could anticipate what would be the impact of these actions. Now we can go to the next slide. It's a disposition effect. Disposition effect is keep losers, sell winners. It's associated with many other biases, they're interconnected. For example, endowment effect, when you bought some stock and you believe it's valuable, just because you bought it for the higher price, the price already went down, but you still wait, maybe it will recover, despite whatever, it's an endowment effect. Or oftentimes disposition effect happen because retail investor enter position and they just said, oh, I'll make 5 or 10% on this position they make, and they sell it, but then the stock goes higher up, like 20%. So this is also a result of disposition effect, or cause disposition effect. In the AI system we are building right now, we will incorporate the reasons. So we incorporate additional data sets, sentiment, client feedback. Like today we do like in-person conversations with investor, asking what did happen. Like, look, this is the performance drag you had. What had happened in this period? But we build it on the system level to capture the reasons to be able to predict the future more accurately. In order to make a future, to predict the future, we need to be very sure about our past. Otherwise, it's not accurate. So our value, yes, anytime.
How do you ensure it's a behavior bias versus structural or liquidity, something else?
Excuse me?
If there's underperformance happening,
yes.
How do you ensure it's behavior and not something else? Like, what will be cause for the underperformance?
Yes, if we go back to the 2 previous slides, we measure them separately. We measure in a neutral way index just from the definition of behavioral, what is behavioral bias is. Index measures whether this behavior exists or not, or associated with transaction or not. We do it in a statistical way. It doesn't mean that we will label one transaction. We need to see the systematic pattern and like cluster these transactions to different behaviors. We often make examples. If I drink a bottle of wine yesterday, doesn't mean I'm alcoholic. I need to show it systematically. And again, depend on many conditions. If I drink, depend on my health, depend where I live, depend on my lifestyle. Drinking wine every day can make me a different harm. Sometimes, for whatever reasons of health, wine condition, or whatever, you can get a positive result. But you surely know that if you drink a bottle of wine every day, you most likely deteriorate your health. So we measured it separately. This is a fact. Observation, I was doing something, and something that in the medicine or in finance is classified as potentially disruptive behavior for performance. But how it affected my portfolio, it's a different scenario, because again, if you are in the strategy that is favorable for the market today, if many other reasons. But statistically, and looking into the past and confirmed by many research, in 92% of the cases, you'll get return deterioration. In 8% of the cases, especially for institutional investors, you can get a positive outcome. The question is how long? Yeah. If it's, yes?
So how do you integrate your own bias while building a model?
Excuse me?
You have bias in the model itself, right, that you're building.
Yes.
How do you mitigate those biases?
Oh, yes, that's a very good question. It's based on, so the models are built not by investors. The models are built by researchers of behavioral finance. And we, especially with AI, we expect to improve the models. But at the moment, it's all the research that was done over the last 20 years is incorporated into these models. There might be some human judgments and biases, and this is constantly being improved. But today, it's the best available, let's say, in this area.
Can you apply for discretionary portfolios or a quant rule-based baskets also can be optimized?
Any investments, we just need to have at least 50 transactions. So it's because it's statistical, so we need to have at least minimum statistical significance of 50 transactions. And it could be any, for example, systematic portfolio based on some rules. We had a client, another pension fund. they had 1.8% behavioral gap due to disposition effect again. Why? Because their strategy was to circulate 25% of portfolio every quarter. And through this quota of 25%, they also had to exit some of the positions they were winning position. And this caused them. So across different strategies, we see different patterns and different reasons for these patterns, but we can measure them and tell, maybe you should review the rebalancing quota, like from 25 to 20%, and this would give you additional 1.7% return per year. That's example of, let's say, systematic or discretionary portfolio. So the difference is the more it goes from systematic to human decision making and process around this decision making, the wider is the gap. So retail has big gap. Like, don't expect less than 8%. Institutional has fewer gap. Hope I answered. Yes.
And secondly, what are the evaluation factors for the models?
For machine learning models, so we simply now the machine learning system is in design phase, and we compare results. So we run several models at the same time and compare results and backtest and take a human feedback loop and actual measurements. So you've seen what system predicts, and what has actually happened is like a KPI. To make the system as accurate as possible, and there's several models run as a parallel with different adjustments. That's for machine learning. But it's not LLM, it's used only as a communication layer. So the behavioral model is not LLM, but the communication layer is LLM. So that's like combination of two AIs. LLM is simply to explain the results. We use LLM to explain the results. Yeah, I hope I answered. Yes?
I think you mentioned in the beginning that you are developing something for retail investors, right?
Yes.
But the amount of information available for retail investor is much lower than a professional investor. How are you going to deal with that when you make that solution?
Amount of information, you mean amount of trades, or? Then it's not for every retail investor.
It's a very high volume retail investor.
Yes. So retail investor can use it, as I made the use case, to pick in between different funds. And it will heavily depend on our partners, the way they will incorporate it. So we build technology and ship it globally as APIs, and then each of our partners, they build their own user interface, their own user story. We help them to explain the results, explain how LLM can be used, but it will be different across different markets.
Yeah, I have one question related to that. So what's your definition of retail investor in terms of in doing these studies, in terms of capital deployed?
It's different across markets.
Benchmark, if you look at any market which you're talking about, in dollar terms.
When we did research phase, I would say retail investors is the one who use retail platforms. So we take data from the brokerage platforms, and average ticket size there is, at least in Europe, in the US, is like 2,000-3,000. Average assets under management, 2,000-3,000. So the definition is it's investor who does investments himself without using of human advisor, and average size is a couple thousands in Europe and the US. But of course, it could be 100. It could be dozens thousands or 100,000. It could be on this platform some limit, minimum and maximum.
Yeah, because in India you have to look at it differently.
Our algorithms are neutral, so in principle we don't care. What we care is we don't care about the size of the transaction. What we care is a price, and the moment transaction has been made. So for that reason, this technology is a good fit for both at the same time, institutional and retail. For us, there's absolutely no difference for the model. The benefit. Yes, another. Yes. I hope I answered, right?
So, when I'm investing with a
Yeah.
fund manager,
Yeah.
I'm actually paying for their bias, right? I'm paying them a fund management fee for their bias. If I have to invest with a completely unbiased fund manager, I might as well do passive investing. Why would I pay, a fund management fee for a completely unbiased fund manager?
Well,
Might as well do passive investing.
so there's a passive investment, let's say S&P 500, and the funds that replicate S&P 500. It shows some certain return, but you pay active manager with the hope, or discretionary portfolio manager with the hope that they will perform better than S&P 500.
Because they have their own biases which will help them perform better than the S&P.
Not just biases, they have their own unique views and investment processes and insights and many other things which make them perform better than S&P 500, but there still biases exist. And they do better, but still they could be even better. They do better than S&P 500, but they could be even better than. Plus, S&P 500 doesn't pay you dividends. S&P 500 doesn't pay you like coupon from the bonds, because we can look into multi-asset portfolios with bonds. So as soon as you want to have portfolio that pays you, let's think in wealth management, that pays you dividends monthly, or you invest and you live for a coupon, like this millions of portfolio and coupon payments finance your life, then it's not S&P. So everything that deviates from S&P might have different risk return parameters, different needs and goals, and different skills behind. Always, 92% of the cases, the skills has also prone to biases. In one form. I hope I answered your question. Yeah, did I?
I want to have an extension to that question.
Yes.
So we are paying the investor for their biases. So why not remove the bias completely, remove the human factor completely, and just tell that's what the data say and invest like that, right? And it will obviously will be better than index, right? Because
Yes.
better strategies,
Yes.
Why wouldn't that be a better product?
So there are two steps into it, or two answers. The first is we are paying for their biases. The truth is the way we measure the biases, a biases measurement is innovation. So we just, our company, in total there are 4 companies in the world that commercialize that. We measure biases in a different way, and it just new. All of us just entered the market and just started to implement this technology in place. So we should expect to have better investment outcomes in a couple of years from human investors. This is the first answer. The second answer: why don't we replace human with algorithms? That algorithmic investment exists for 2 decades in hedge funds. There are tons of algorithmic hedge funds. The problem is still today they're highly risky, and many of those complex AIs, they are not explainable and they can deviate from the market. It's the same question when we drive around Mumbai, right? Why can't Google predict our travel time? Because it can't. It's so many. So. Huh? So if we speak about prediction, so you heard that prediction, we already do research for 5 years, and we'll do another 2 years. So it's a very complex question, and we need to, in order to predict the future, we need to be very sure. However, today we already measure the past, which is innovation, and this innovation was 20 years of research. So it's not just, and the past is a statistical model, it's not machine learning. So we can clearly explain the parameters of the model, how the outcome has been calculated, and test it into many data sets to see the result that indeed it captures and explains. I hope I answered that past is a statistical model.
That's obvious, because we already have that has happened already. Right?
Yes.
The use of a model is to predict, right?
Yes. Yes, and even if you do all this job, all the PhDs and professors doing research for 8 years, financial markets are so complex that at the moment, maybe on the quantum computing it will happen. I might expect like with quantum however, quantum is also probabilistic outcomes. We do consider quantum computing to maybe increase the accuracy, but it's...
Wouldn't the behavioral science help you with that? Because market is made up of people.
Yes.
So can't that be fed into the prediction part rather than the
Oh, that's exactly what we do. We fed behavioral part into the machine learning models. But because it's machine learning and the question is very complex, you still might expect some drift, and you still need to have a human at least foresee this for another 5 to 10 years. I don't know the future, but we still foresee that the human would need to be supervise this model, and it's just a model that suggests him. Based on behavioral trails. There's lots of like signals, for example, sentiment signal models that are embedded, or lots of analytics that embedded into professional workflow, but still there is a human who make a judgment because this model can deviate, the regimes has changed. It's like we compare it to medical doctors. They do use a lot of devices, a lot of software and hardware to make a diagnosis better, to be more clear, to understand what's going on to this human. But sometimes you need to make old school checks combined and some of the human judgment of his reputation and his career to make it safe for you. I don't think that any one of us would like at the moment that our AI would cure cancer, like life situations. And our wealth is our life. It's something that makes us, so it's comparing to severe medical cases. You want to have a human, right? Anyone wants to have a robot doing your operation? No, that's the same. That's the same because we speak about wealth. If we speak about retail investment, which has low penetration, low investment, yeah, there's lots of AI, and then something happened. Something happened, like with hedge fund. You know how many algorithmic hedge funds with the best professors and quants went bust? Every second. Yeah. Oh, more questions or? Yes.
Final one. So, let's imagine a scenario where these behavior analytics, what are the guardrails do you have so that they don't nudge the investors to perform better or to risk more?
Because risk return are always embedded into the model analysis. So in professional investing, there's always parameters that consider risks and volatility, value and risk. Even today, when we do any past reporting or suggestion of alternative strategies, we look into volatility and value and risk. So in professional investment space, drawdown and volatility, value and risk are always embedded into any return suggestion and optimization. So it's not just let's optimize for maximum return, because the more return you take, the more risk is associated with this.
I'm an investor and then my analytics say that I could perform better. And
Yes.
I could be, let's say, I'm in some sort of a psychology so that I get rage baited to perform better.
Yes.
And that might lead to more risk.
Our system would not produce a recommendation to give you more risk. It would.
What are the safeguards that do you suggest or ensure so that this doesn't happen?
It's embedded. Like when we speak about wealth management and wealth management adoption, it's like default question. I should probably start with it, but whatever measure we do, recommendation produce, it has the same risk parameters as the one you already taken. We don't set the risk parameters for individual because it's their strategy. If you invest into, let's say, emerging markets, equities, Indian equities, there is more risk than to invest into European equities. Depend on the mid-size, cap size of the company, different risk. Whatever investment strategy you have chosen as investor, it has a risk, and we optimize around this risk. We set this risk level because it's your choice, and we want to make it neutral.
Just one last question. Just to understand the graph,
Yes.
because Q2, Q3 are a positive return,
Yes.
You were ended up studying people. That's the reason why this position increased. Is that it?
Yeah, so that's also a very interesting question. It's a very, for me, we had so many brainstorms, have to make it more understandable, because here they have quoted 324, and historically they had negative disposition effect, and they even made money on market timing, on exiting entering positions, and then model captured the increase and increase of the disruptive behavior, and it resulted into the negative outcomes with time lags. So this is how you can explain that. But and we investigate this now into large data sets of thousands of ETFs. What are the relationships in between index and impact? Because we measure impact of these behaviors and index separately. And now we investigate the relationships. What we see is that often it appears with time lag. In 8% of the cases, negative effect appears with time lag. And in 9% of the cases, this behavior will lead still to positive return. So we investigate now the relationships and the reasons, and as I mentioned, like triggers, and combine many other data sets to investigate the reasons to make prediction. Because at the moment, if you don't know the exact relationships with time lag of the impact, we cannot make a good prediction. And yeah, that's an area of research.
Hi, one last question. So I don't even know if I can articulate this question accurately, but my question really is, how sensitive is this to time, or what is the time underpinning this sort of bias analysis? Because a part of the answer to the question that this gentleman asked versus bias versus passive lies in the fact that every active manager is betting, knows that the markets are efficient, but betting on a certain level of inefficiency in the market, which amplifies his bias in a certain time frame, but can look like prowess or efficiency over a different time period.
Yes.
So how does this capture that? And in your analysis, wherever you've applied the model, is if you take different time periods for analyzing this, could the results be vastly different?
Yeah. So that's again, to answer this a very good question, and similar to its area of research. At least what we can do at the moment in a very accurate way, we measure whether these trading actions of the investor is associated with a bias. Is there any bias exist or not? But as I said, the impact of this bias is the area of active research. How we can build a robust connection in between the impact and the action appearing, considering all the other factors that might influence investors, all the other macro factors that might impact his strategy, based on the strategy. So there's a many, yeah, in order to make an accurate timing, I believe it will be, as I said, another 2 years. It will be part of our suggestion system, which we are building right now.
And what are the constraints, in your view, what are the constraints around this model?
By constraints, you mean?
Limitations of this model. What is it that it cannot do? Or what is it that it could get wrong?
Skilled investors. So we mentioned 92% of the cases, it's all statistic based. So if there is edge case of very skilled investors, they already broke the model. We already experienced that, because with our asset managers, they bring us, our clients normally start by bringing us the best performing investor, the worst performing investor. And the best performing investor indeed shows a positive behavioral gap. They always behave better. And sometimes they behave so well that it breaks the model. But since it's innovation, there is lots of tweaks we are doing to improve it, improve. And I would say my personal biggest limitation today is that I need to supervise every result. I need to look into every result. Plus, if we measure historical performance, we source market data. And simply because of the market data providers not always provide the best results, there are errors, some prices are missed, and then it also distorts the results. So we build agents that do lots of checks, and we learned about with every new strategy, with every new asset class. So today, at the moment, we need to check with agents, luckily they exist, the workflow that there's a quality data in, and then have a Chinese wall that human reviews the result before we expose them to asset manager. To make that this is the biggest constraint at the moment, the low quality data of data providers, and these edge cases of the best performing, low performing that break the statistical computation, and then we need to do adjustments.
Last question, please.
Hi, Yulia.
Hi.
I have two questions for you.
Yes.
And the first one is, during the initial stages of Yainvest,
Yes.
this is a model where the investors have to trust your biases. So how did you get people, before it got recognition that this is a model that can be used and it's trusted, how did you get people to trust your model, try it out?
It's based on our reputation and adoption of the market, of course. So we work with biggest banks in Switzerland and with Morningstar. And the professors, so if we get back to the team, the professors are well known in the industry. For example, Morningstar has 16 people. And the head of behavioral finance in Morningstar used to work with Enrico, my co-founder, and students of Enrico work at Morningstar. So there's already students who get out and become our clients. And so for 20 years, Enrico and Torsten provided consulting in terms of quantitative behavioral finance to biggest banks. So for example, when we come with this algorithm to this big bank, the head of quantitative finance at the bank said, I trust the algorithm. So like, green light, I trust the algorithm. This is because there's nothing better. And this is truly robust, and it's proven by 20 years of delivering different algorithms to the wealth management. And we start with them and then bring these use cases to other clients and saying, look, this is who trusts us. And yes.
Final last question. Actually, I forgot.
It's okay. You can find me anytime, and we have.
As soon as I remember, I'll ask.
Yes, sure. Any other questions to me?
Yeah, I remember.
Yes.
According to you,
Yeah.
the kind of saturation that we're seeing in software as a service business model, do you think this is a good time to dive into it and create your own language models, or do you think it's too saturated as of now?
We don't do large language model.
If not large language models like this, do you think it's too saturated this space, or to do something of your own, or no?
So it's our own foundational machine learning models. It's our own research. Like our own models, they are patented. It's not LLM. Like everyone, we use LLM and agents for improving our operations, improving our service, improving outcomes. So I think LLM and agents, if you build it as standalone business, you need to be fast and sharp, or standalone service, because there's anyone else who's doing that. I cannot imagine an application today that would not use agent or LLM, because it so much increase efficiency. It so much increase the human interaction layer. Then I hope I answered. So we are not doing LLM, but we embed a lot of LLM into our workflows on the operation side and on the client-facing side. Yes. Oh, thank you, everyone, for your attention, for all the questions. It was extremely interesting, and I hope.
Give her a big round of applause, ladies and gentlemen.
Yeah. maybe last side. If you liked it, you can ask your broker to enable that, because we work a lot with Indian companies, and if you start speaking about this in LinkedIn and any other ways, it will help us to bring evidence. Look, your people want to have the solutions, they want to invest with it, they want to know their biases. Please make it happen, because it's up to you. And thank you again.